Atlantic, as Gwen said, is a company that is in construction right now and on what we call our base case production development. We're going to produce just under 90,000 ounces a year for a minimum of 9 years. And that will give you guys, I would imagine, an exposure to what we all think being the gold price upside. In addition to that, we have two further deposits on top of our base case, which will give and offer a further leverage to any future gold price upside that I think is attractive. I think the other thing from a risk perspective as an investor is that, as you'll see, our project is a low cash cost, which means that if the gold price doesn't go where we all think it's going to go, then we're going to survive and we're going to make really strong cash flow notwithstanding. I'm also going to, I'm doing this on purpose because I keep your attention so you don't read the slide, but I think we offer 3 or 4 differentiators as a company compared to our peers. One of them is the degree of ownership of board and management. Board and management own in excess of 35% of the company, so if you were to become a shareholder of this company, you're very well levered to the same upside and to the same future that we have. We are a senior company management group in a junior package. Our COO, Maurice Belanger, is a former senior VP at Kinross and more recently at Goldcorp. The third differentiator is the speed with which I think you'll see us developing this asset from concept through to construction through to production. Time is money in this business, and I hope to leave you with the very clear understanding that we're focused on advancing towards cash flow and generating those returns. So with that, I need to show you that. And this is a slide which shows our 4 deposits, roughly 2.1 million ounces of open pitable gold at around 1.5 grams, all within truckable distance of a central milling facility that is presently in construction. The base case that I talked about earlier for our economics is the development of the Tukoi and the Beaver Dam deposits. The second 2, Cochrane 15 Mile, are the upside that I talked about, where we're presently drilling those off to bring them into measured and proven status. But it's those bottom 2 deposits, the Tukoi and Beaver Dam, that are presently in our life of mine plan. Our capital structure is, as you see, we have a market cap of around $170 million. Insiders and associates own in excess of 35% of the company, as I mentioned earlier. My friend Rick Rule at Sprott has a significant position of 12%, and we have a number of institutions also on our register. This is the timeline that I was talking about earlier. What this is saying is that from concept through to construction, a period of 18 months. That's unusual. I've been in this business for 30 years. Typically, that time frame is 5 to 10 years from concept through to construction. We pulled together these properties in the latter half of 2014. Feasibility completed in the middle of 2015. Environmental and permitting was completed in October. Debt financing early this year. We entered into a fixed price contract, and that is important because I'll talk to that in a moment, because that's all about our risk management approach. We entered into that earlier this year in about March, April, and we started construction in May. And we're about 5 months now into a 15-month construction schedule. That 15 months also is a exemplary timetable in order to build a gold project like this. Typically, you'll see elsewhere in North America and elsewhere in the world about 2 to 3 years even. But we expect to commission the plant in September of next year, I should say, and ramp up production in Q4. So that's a 15-month construction schedule. There are economics at the various gold price, Canadian dollar gold prices they are, by the way, And as you can see, very strong, robust economics, 35, 40% IRRs at today's gold price. Low cash costs of around 690 Canadian all-in sustaining costs, or around 518 US dollars at today's exchange rate, which means that if we're going to have to suffer a little lower gold price, we're still making a very, very strong margin. And this is the margin demonstrated another way. That margin right now is around $1,000 an ounce Canadian, based on our 690 all-in sustaining cash costs. That's largely a function of where we are and a low strip ratio in the resource. We're located literally 45 minutes from the Halifax International Airport, and I can tell you, having been in this business for 30 years, that makes a huge difference. We're not flying fuel in on ice runways and somewhere way up north or in the jungles of South America. This is a really easy project to operate and to build. That's our production profile. As I said, just under 90,000 ounces for the initial base case scenario, where we are developing and processing ore from Touquoy and Beaver Dam. Low strip ratio, as I mentioned earlier, which is a big driver to those economics that I mentioned. This is a picture of a recent picture of the site. As you can see, we are getting on with construction. It's a very easy, flat part of the world to build a gold mine. Rather green too, as a matter of fact. That's a recent picture of our reagent building and some of the leach tanks, as you can see, starting to come out of the ground. We're well into construction. Moving to that upside that I talked about, we have 1.1 million ounces of gold that is in resource category, indicated and inferred, that are not in that mine plan and not in any of those economics that I just talked about. Those 1.1 million ounces are currently being drilled out. We have three drills actually at Cochrane Hill right now. They'll move into 15 Mile Stream. And the idea is we'll bring those into measured and proven status, which will allow those same ounces to be folded into the life of mine plan, boosting production and as well as extending our life of mine and at the same time generating an even stronger economic outcome. That's the two northeasterly projects, 15 Mile and Cochrane, where we're focusing on, as I mentioned, and we've got a couple of other targets in between 15 Mile Stream and Beaver Dam, where we think we will discover at least one and maybe more additional deposits that fit in between that Beaver Dam and 15 Mile strike length. That's an additional upside that we can't measure right now. We can measure the ounces that we have at 15 Mile and Cochrane, but there's some other deposits that I think will generate a string of pearls of deposits that will all get trucked into our central milling facility. Just to give you a sense of the sort of economics that will drive, if we brought just the Cochrane Hill deposit in, that, as you can see, will push us through 200,000 ounces in annualized production and really strong cash flows and internal rates of return for a relatively small amount of additional capital of about $108 million. And that proposal has us bringing that deposit on in year 3 of our current development. I won't tend to spend too much time on this, but because what this is supposed to say to you is that compared to our peers, we represent deep value. Another more simplistic way to do that is if you consider that we're going to be producing around 90,000 ounces per annum, and if you consider that our cash cost margin, after sustaining costs, will be about $1,000 an ounce, that's $90 million of cash flow per year. And our market capitalization is $170 million. That's, in other words, we're less than 2 years of our cash flow in value. The risk side is also an area of this business that I think is under recognized. This business of mining, and gold mining in particular, is a business full of risk. There are no guarantees in this business. But what you can do as a management group after being in this business for 30 years is focus on how you manage and minimize those risks. For example, Gwen, I think, mentioned earlier in the last cycle, the big companies overspent on their projects when they were building them. Well, there are ways to manage that, and one of the ways we've managed that risk to a large degree is the fixed price that we have for the build of our plant. We have an engineering and construction guy who will build it to a price, and that's all he's going to get paid. And frankly, that's the way it should be, rather than these cost-plus scenarios that you see too common in this business. We also have a drilling approach which is called grade control, which is common in West Africa and Australia, less common in North America. But what that is all about is reducing the resource risk. We have data that is 15 times more dense than the average 43-101 proven reserve that you'll see in most companies. And that is about a 10 by 5 grid spacing on a rolling basis for our production plan. So we're ahead of ourselves, so we know more about the tons and grade that we're going to mine and put into our mill than most companies because of that data density. It's also an open pit mine, by the way, which is significantly lower risk than an underground mine, because it's way more manageable in terms of waste and ore assessment, waste and ore mining, and delineation. So we are one of the few companies in this at this conference where we have a gold mine. It's in construction. It's in Canada, which is another huge advantage, and a really strong cash flow that we expect to start to ramp up on in September of next year. Thanks for listening.